Hi, and welcome to my channel. For those of you new, my name is Dave and I work in financial services. And these videos are a mixture and journey towards financial freedom. They will cover financial products and financial well-being so you, like me, can reach your goals sometime in the future. Now let's get into this latest video. Just when you thought 2023 was getting some kind of back to normality within the world of investments, so we've seen the recent events such as the pandemic, record inflation for the past 45 years, we are now hit with a so-called fresh banking crisis, which long-term investors will remember what happened way back in 2008, which then resulted in the immediate acting of bailing out from the big banks and then years of lack of growth, lack of investment, or poor market sentiment towards the financial sectors. So most people were then attracted to other areas within other assets or other sectors, shall we say. Now, I'm not going to go into recent events about what's happened with regard to the collapse of the Silicon Valley Bank and Silvergate over the past few days, but hopefully it is restricted to certain kinds of bank lending within a certain sector of the economy. But one thing the markets do hate is uncertainty. So that's why we've seen a great sell-off in the past few days. Now the markets in both the US and the UK seen a drop of 2% on Friday. And also with regard to today, we've seen another drop of, so we say, 2% within the FTSE 100. With regard to the main banks within the UK, they reckon that's about £10 billion off the face value of the biggest banks within the UK. Now, one thing the markets hate is uncertainty. And the great unknown is what sort of sectors or exposure do these banks have to the technology sector in the short term, a liquidity issue? Or is it the start of something maybe which have bigger, wider implications towards banks across the UK and Americas, or even a global banking crisis? Now, in recent days, the big banks such as NatWest, Lloyds, Barclays, HSBC have all recorded good results, good strong results during the month of February. They've got greatly improved balance sheets, much better capital ratios, and they've increased dividends paid out to shareholders. But the markets didn't react well to the banks or the results due to provisions, bad debts, and write-downs included to so-called clients or companies. Now, as a result of interest rates being increased over the past few months, the bank's profit margins shall increase, resulting in better profits, profitability moving forwards. But the side issue is people are struggling with their debts due to affordability. Now, we've seen steps over the weekend to hopefully alleviate the situation, but is it a short-term fix? Now, today, HSBC has bought up the UK banking arm for £1. Now, this has had little effect on today's events, as the FTSE is again down 2% at the time of recording, and the UK big banks are averaging between 3 and 4% for today alone. So what do we do moving forwards? Well, the first thing is not to panic and sell off any existing holdings if you don't need the money. Now, you may have invested in companies directly or through funds or ETFs, and your portfolio may look like a sea of red showing losses across the board. But a loss is only a loss on paper. It is not a real loss until you sell or crystallize, and this will also affect, shall we say, buying costs to sell the shares, exit the market, and it will also create a double whammy when you buy shares or funds in future, which will then obviously cost towards your portfolio. The best thing you can do in a way is to sit tight and try and switch off from all the market noise. Unfortunately, the news only covers bad stories, so it creates a fear and people panic. Now, the so-called banks have all had to put in financial assumptions, stress tests, so they've got to meet certain governance rules, certain liquidity issues, so hopefully a repeat won't happen of 2008, shall we say, the original banking crisis. Now remember, this is on my own opinions. If you like the videos, smash the like button, subscribe to the channel. So let's see what sort of impacts it had over the past few months or years. Now, if you look at the following chart, a simple graphic of what the S&P 500 has done or performed for the past 5 years. As we can see, it has produced a return of round about 40%. So let's just say an average return of 8% a year, which is somewhat surprising as it included the pandemic period, the time of record inflation we've not seen for 40 years. We've seen a war in Europe. We've seen a cost of living crisis. We've seen a chip and supply shortage. So if you're concerned about individual stocks such as the banking sector, it may be reviewed that you review allocations and holdings and stock picking in future, and don't become top heavy in one sector. You may wish to diversify, shall we say, or you may wish to buy funds such as an S&P 500, which covers the top 500 in the USA. Or you may decide to invest by a global tracker fund. So ride out the short-term blip on market conditions and think long-term. Getting rich by investing is not a get-rich-quick scheme. You will have good months, you will have bad months. You will have good years, you will have bad years. But it's how you react that makes you a better investor. So look at the simple graphic, year on year, simple chart for the last 5 years, 40% growth, an average return of 8%. I'm going to break the following chart into my own personal journey. Okay, so this is a simple illustration of my stocks and shares ISA, how it's performed over the past few years. Now, it's not to say look at me or boast and brag or how good I'm investing. It's to prove you will have poor years of performance. You will have good years. But you can create a sizable portfolio if you stick to your plans, your principles. My aims is to invest on a regular basis within a tax-free investment wrapper. I buy stocks, I buy funds on a monthly basis by what we call pound cost averaging, and all my dividends are reinvested back into the portfolio, and we can use the power of compounding. Now, with regard to my stocks and shares ISA, it's currently about 47% invested in financial services, so the big banks, insurance companies. It's an area I work in, it's an area I have been investing with. Now the portfolio owns 9 stocks, which makes up 46% of our portfolio, and we own 12 funds, which makes up 53% of our portfolio. And as we can see, the portfolio has increased year on year, mainly due to contributions, mainly due to dividends. Now last year we received £1,500 in dividends. This year we're hoping for £2,400, so an average of £200 a month. And look at the following, shall we say, the graphics. Look at the annual returns, just to prove there are good years to bad years. In 2018, it increased by 5%. In 2019, 29%. In 2020, 14%. In 2021, 19%. And last year we were a loss, we were down 5%. And year to date, when we've done our last record at the end of February, we were up 7.24% for 2023. Now, obviously what's happened for the past few days, the figure at the end of March will be nowhere near that. We may even be showing a loss. But the portfolio may show a sea of red today, but we can just switch off. And although we may look at the month-end valuation may be lower, okay, we have no immediate plans to sell any existing holdings, and we may even top holdings or shares or ETFs at the start of April when the new tax year starts, as I see it as a great buying opportunity. Remember, it's about long-term investing. Try and ignore short-term reactions and events. You will only drive yourself mad looking at prices several times a day. You can only control your own investments. Remember, time in the market is better than trying to time the market. Now, I may log into my account, let's just say 1 day a week, to see a headline figure or to read daily market news, results, trading statements, but it's how you react to those market conditions and events. It will make you a much better investor. Okay, think long term as an investor. Now, we've seen these events before, shall we say, the technology crisis, the banking crisis, the pandemic crisis. The market has recovered, okay? We will no doubt see them again, whether it's in 6 months, 12 months, 5 years down the road, okay? Some things are out of your control, but it's how you react to them, okay? Stick to your plan. stick to your investment opportunities. And as we said, if I can build a portfolio, you can build a portfolio. Remember, okay, investing should be seen as safe. It should be seen as boring, okay? If you want something more exciting, go and invest in different assets, okay? But think of it as a long-term plan. You will have good years, you will have bad years, and how you react will make you a much better investor. But you will meet your objective in the future. It may be 5, 10, 15 years down the road, okay? But stick to your plan. And remember, if you like the videos, smash the like button, subscribe to the channel, and we'll see you again in the next video.